Good evening, it's Mansfield's Money Sense and you're welcome to it. I was in the post office the other day. I think I was going to renew my vehicle license, and standing in the queue I saw this document and I thought, that looks interesting, let me take a look through that. RSA Retail Savings Bonds. It said it's the smart way to save. So I started having a look at it and got quite interested, and that's the reason why we've invited Monale Ratsoma, who is the Chief Director of Liability Management at the National Treasury, to join us this evening, because the National Treasury are the people who bring the retail savings bonds to South Africans. Welcome to the studio, nice to have you with us.
Thank you very much.
Monale, explain to me now, what are these things? Firstly, how did we come up with them?
Well, I mean, Jeremy, first, I hope that you picked up a brochure and you end up buying some during your trip. You know, they were formulated in 2004, and the idea behind them was that first was to mix funding for government. When I talk about funding for government, you might be aware of bonds such as the 157s that we always daily talk about, which in themselves, they go towards funding the government expenditure, the shortfall between revenue and expenditure. Okay. So retail bonds are directed more towards retail investors, normal men on the street like yourself and myself. And the idea there, of course, is also that you want to introduce the concept of saving, or you want to make sure that you know, communities or households save. I mean, the other problem that we have as a country is that households save very little, in fact, towards not saving at all. So it leaves only government and corporate as the sole savers. So the mechanics of retail bonds, in fact, are earmarked towards just introducing the concept of saving towards households.
Okay, let's just go back a step here. What, more or less, do you know, or can you tell us what the difference between expenditure and income is with the government? What sort of gap is the government having to fill by using the various types of bonds that it issues?
Yes, I mean, we pay tax. I hope you pay tax.
Yes, of course.
And the government collects tax also from VAT, from corporate. That constitute national revenue. Yeah. And then there's expenditure. So the difference between what the government actually has to spend and what they receive is a shortfall, which then in itself means that the government has got a borrowing requirement. Yeah. That borrowing requirement is meant by my department having to go to the market and raise bonds. In the domestic market, also in the foreign market, retail bonds are a component of that. To date, retail bonds, I think, the amount outstanding is to the tune of about 12 billion. So it's fast growing to become a very important source of government funding. But the main, the primary purpose is in fact to introduce households towards the concept of saving, okay, which, towards increasing savings as a percent of GDP to about 6%. That is when we're looking at households. So, sorry, let me get this right. You're saying the bond market is worth about 12 billion, or the retail sales bond? The retail bonds, the ones that have been bought so far are to the tune of about 12 billion. Okay, wait, hang on, that's pretty impressive. And I think we should pat ourselves on the back, because in 2004, that 11 or 12 billion between 2004 and end of 2011 was just shifting, would have been just shifting around in the market, doing other things, where it's now being utilized in government expenditure. Yes, Jeremy, the concern that we have as National Treasury is that, in fact, what has happened here is you have seen money flow from one saving account to another. So we are attracting money coming from other banks into National Treasury, which is is not what the purpose of these retail bonds, in fact, have been. We want to start attracting new money. So hence, in the new strategy that we will be rolling out this year, we're trying to go more into communities. And you might be aware of the amount of inroads that the Post Office, in fact, has done through stokvels, that they've managed to get new money coming through. We also want to start accessing new money. And hence, even as the retail bonds amount has grown to the tune of 12 billion, we haven't seen that being reflected in the household saving ratio, meaning that this is money that was in savings account, you know, to start with. Yeah. So we want to push that ratio, and for us to do that, we need to start getting new money to come through.
Okay, but then having said that, let's go back to step one. How do you qualify for a retail savings bond?
In the very same way that you open an account. I mean, if you've got a South African ID, you can either go to the post office, and of course you need to have a bank account. You can go to the post office, and there are forms there similar to the ones that we have seen. or you can telephonically call the National Treasury, and then you can open an account via the telephone, and then you can make an electronic transfer. We've got a website which is www.rsa.retailbonds.gov.za. Through that website, you can in fact be able to open an account. Even at the Pick and Pay, I mean, you can call in to us and open an account and go to the Pick and Pay and transact your deposit through the Pick and Pay. So we're utilizing all the stakeholders to be able to access more and more, because I mean, these are fairly young products. In the future, we'll be looking at probably rolling it out provincially and coming up with our own network. But for now, we have to rely on the infrastructure that exists through the post office, and to a degree that exists with Pick and Pay.
Well, I mean, it makes sense. Instead of reinventing the wheel, use those cogs that are available to get them out. And by the way, don't get all frantic and start trying to write down websites and all the rest of it and numbers. We'll put those up for you a bit later. Okay, so just relax and take a listen to what we're talking about, because it may be of interest to you. It certainly is of interest to me, I'll tell you that much. When you talk about going down into communities now, is there not another instrument that you need to create here? Because I understand you've got the infrastructure in place there. You can phone up, you can open your account, you can then go into any post office, which are very widespread in the communities.
Indeed.
You can go into any Pick and Pay, also widespread. Through their associates, I would imagine Boxer and Score, you can also buy retail bonds.
Yes.
Those are widespread in the community. You've said that you need to be a South African citizen, but as far as I understand, and I may be wrong, your minimum investment is R1,000.
Yes.
Is that not too high when you start digging down into the communities?
Well, interesting you say that. At the moment, yes, is minimum 1,000 and maximum 5 million. There's a new product that we're looking to launch within this year. It's called a top-up bond. A top-up bond means that you can throw in money when you have it,
okay,
at your own convenience, and then you can build your portfolio. So this is an instrument that, as we seek to go deeper into communities, we think is going to probably work the best. And you might also be aware that, I mean, these instruments, in fact, you pay no fees, you pay no commission on them. So the result, what you put in is what you're going to get out, plus the interest that you would have earned.
How is that interest calculated?
It's calculated on a semi-annual basis. I mean, let's split the instruments, because you've got the fixed rate instrument and you've got the inflation-linked instrument.
Okay.
So let me start with the fixed rate instrument. You take your 1,000 rand and you invest it for 2 years, as an example. On a semi-annual basis, interest will be then will then be deposited capitalized into your account. And after a year, you've got a choice to reset your product. Reset meaning that if interest rates have gone up, the 2-year fixed bond has now gone up versus where you have invested. You can reset and now start earning a higher interest. So that flexibility also makes our product much more superior. And then coming back to look at the inflation-linked. Inflation-linked, what it does, it just says it hedges you against the rise in inflation. So you earn a real interest rate. So this is the mechanics. So you deposit 1,000 rands, and we're saying we're paying 2% real interest rate. It sounds low compared to the other fixed nominal retail bond. But the difference here is that as inflation rises, so your money grows by the amount of the inflation increase. Okay,
so let's say inflation is sitting at 6% now, just for example.
Yes.
And you've got 2% above that, you're going to be earning 8.
Essentially, that's what you earn.
If inflation goes up to 8, you're going to be earning 10.
Indeed.
But if it comes down to 3, you're going to be earning 5.
Well, that is the downside of it. So, but the real interest rate is capitalized.
But the thing is that you are guaranteed that 2% above inflation.
Yes, you're guaranteed 2%, and your nominal invested then will grow by inflation. Then inflation goes to 15%. Happy days. Then you've got the 2% plus the 15% that your money is in fact earning.
Okay, but then happy days for that person who chose that option, but the person who chose the fixed interest rate, and let me say I bought my retail savings bonds and said, hey, I'm going to make plenty of loot here because I'm putting it at 10%. And then suddenly inflation goes through the roof and we're sitting at 14%. Yes. Are you, with that change that you were talking about at the end of the year, are you able to then ratchet those numbers up
Yes, I think let's just again work a little bit into the detail of this, because these products are linked to the government yield curve, which is where government borrows money in the financial markets. Mm-hmm. So if, for instance, that yield curve moves with inflation, and it's most likely because as inflation rises, then you're likely to see a response coming through from the Reserve Bank with high interest rates. When the Reserve Bank hikes interest rates, the government yield curve also tends to move up. So we therefore will have to reset the rates that we put on the website. So by you seeing the rates that the rates have in fact gone up, after a year of your investment, you can come back to us and say, oh, listen guys, I mean, I've put money here at 10% and it's been a year and I see now in fact paying 15% for the same product. Mm-hmm. Reset. Then you're adding a higher interest rate. I mean, how wonderful.
Okay. It all sounds too good to be true now. There've got to be some downsides to this. I mean, firstly, the first downside I can see straight up is that it's non-transferable and that you're locked in.
Well, you're not necessarily locked in. I mean, locked in, sounds like you can never get out. You can get out, and of course, I mean, when you get out of a product that is fixed in its nature, there will be some penalties. I mean, in this case, suppose you invest for 2 years, but you get out before the 2 years, and of course, it means that you might have to forfeit the interest that you're supposed to earn in the 2-year horizon. But your capital, in fact, still remains. I mean, that's another plus. In fact, I struggle to find the negatives around this product. I mean, every time you look at the products, the makeup, there's very little that you can say. In fact, I mean, this is where I think as a consumer I'm going to lose. And I mean, from a government point of view, I think it will not be viable, or it will not be in good moral standing to be designing products that can be to the detriment of the consumer. Hence, retail bonds have been designed that they are in themselves foolproof and they are there for the benefit and also to try and improve savings as per the mandate.
The retail savings bond is what we're looking at this evening on Mansfield's Money Sense. I want to come back to the investor profile that exists at the moment because there's a very, very interesting anomaly there.